Hello, everybody, and welcome to the second lesson on the Trade Life Cycle series, where we're going to take a look at understanding equities as an instrument. Here, we are not going to be discussing trading strategies, options, strangle, straddle, what is the profit to be made on, buy today, sell tomorrow, and there are no stock tips to be provided, etc. We're going to clearly understand what is the meaning of equities, how the instrument is depicted in the stock exchanges. If you've seen my previous videos, you'll understand that I mainly focused on getting you good careers, getting you good jobs at some of the leading investment banks across the world. The first lesson in trade life cycle already had a detailed look at the financial markets. If you haven't had a look at this video yet, then I recommend you take a look at this video. I'm sharing the link of the first video in this so that you understand the sequence in which the videos are flowing. Let's get back to equities. When we hear the term equities, the words that pop up into our mind are terms like ownership. Okay? Sometimes you might also hear words like stock exchange, and other times you might hear words like dividends. So let's understand each of these terms in the context of why equity processing, okay, is such a big deal. Look, the markets have already moved from T plus 3 to T plus 2 in many countries in the world. In markets like India, which process almost $1 trillion worth of trades every year. We are settling on a T plus one basis. So let's understand the meaning of different types of equities. Why is it important if you're a global competency center of, let's say, some of the largest banks like Morgan Stanley, Wells Fargo, Goldman Sachs, Deutsche Bank, etc. Why is it so important for you to understand these concepts? Moving on. Equity basically means proportionate ownership. Okay? So when you own equity, you are owning a part of the company's capital. So what is it proportionate to? It is proportionate to your percentage ownership. So the next question that comes to your mind is, what are we comparing this to? We're comparing this to debt. Okay? Debt basically means the concept of understanding that you have some preconditions towards taking the loan. Okay, so in that's not how an owner behaves. Okay, let's say I have a small little mom and pop kind of a grocery store at the road end. I have put in all my life savings into that shop, and whatever are the profits are mine only, right? So that's ownership for you. On the other hand, if I go to a bank and I tell the banker, "Can you give me a loan for $500,000 to set up the shop?" and he says, "Okay, what are you going to give me as collateral? How much interest can you pay? And how long you want the loan for?" So all that becomes a part of debt, which is a contractual obligation to pay the interest and to repay the principal on time. So, but equity means proportionate ownership. If I, at a retail level, at an individual level, if I buy a house with all my life savings, okay, and my spouse's life savings, that house is entirely mine. The assets are mine. The cash flows are mine. The returns generated from that house are also mine. All that becomes a part of equity. If, on the other hand, I go to JP Morgan and take a home loan, or I go to HDFC Limited and take a home loan, then that is no longer mine. It's the ownership is mine, but I have to repay the loan as well, right? So that's a contractual obligation. So this is a very basic understanding that many people kind of get confused about as to why we call it as equity. So equity basically means ownership. Equity holders have participating voting rights. So companies are huge. I mean, look at a Tesla Motors, right? It has got $1 billion market capitalization. It employs more than 25,000 employees. Take a look at IBM. Take a look at JP Morgan. Those numbers are, multiplied multiple times. So then, as a shareholder, how do you monitor the company? How do you decide whether the company should take up key strategies, who's the board of directors, etc.? Some of the shareholders therefore participate in what is called as voting rights. That's the right to participate and take important decisions. Okay, so that's the meaning of proportionate ownership. You don't really run the company, you run it to the extent that your partnership with the company is associated with the extent of participating in those important meetings, helping out in the key strategic decisions, etc. Now let's take a look at the different types of equities, because yes, there are many, many types of equities. The list is endless, but I'll just dwell on some of the ones that we'll be more familiar with in the US markets, because many of the investment bankers working here in Bangalore, Hyderabad, etc., are trained to do the processing for the US markets. So let's take a look at some of the equity types in the US markets. The first one is called as common stock. So when you look at New York Stock Exchange, NASDAQ, and market capitalization of these numbers, they are mainly talking about common stock. Common stock is also called as shares in the Indian context, but most probably it's called as common stock. If nothing is mentioned about the characteristics of that particular instrument, it will be considered as common stock. One share is equal to one vote. So where are you going to vote? Okay, so now you're going to vote at the annual general meeting, which takes place once in a year to finalize the profits and losses, books of accounts of the company, or you can also vote at any extraordinary general meeting. Okay, so these are some important terms that we come across when you talk about corporate actions with respect to voting rights and stuff like that. The common stock shareholder has a right to share in the profits. In the case of equities, that is called as dividends. So be careful about the term that I'm using over here. I'm calling it right to share. Okay, that means you get if the company makes a profit and if the company decides to give dividends, then you will get a right to profits. That's the meaning of common stock. What else kind of stocks are there? The next one that we often see in the US markets, not so much in the Indian context, but very, very much in the US markets, is preference shares. Preference shares can be issued by the same company that has issued common stock. So a company can issue both common stock and preference stock. The preference shares has a preference over common stock. So what is this preference? Why is it preferred stock? Okay, the preferred stock gets fixed rate of dividends. Okay, so like I explained to you in common stock, if the company makes profits, if the company wants to declare dividends, then they can decide dividend rates, which have to be approved by the common stockholders who have a 1:1 voting share right, etc. In the case of preferred shares, if the companies make a profit and if the company has decided to declare equity dividends, it must pay the fixed rate of dividend. So a company's preferred stock is the rate of dividend is announced beforehand at the time of issuance. Yeah, whether it's an IPO issuance or it's a private equity issuance, the fixed rate of dividend is already announced over there at that point of time itself. The second, there are many types of preference shares, okay? Like going into an ice cream shop and then, oh, yummy, you get completely, befuddled with all the options that are there. So let's take a look at some of the examples of the different types of preference shares. The first one is cumulative preference shares. Now, this is a little funny term to understand, because what do we mean by cumulative? Cumulative means that dividend payments can be cumulated. This is reference to the dividend payments made by the issuer as a company. The unpaid dividends in a particular year, let's say a company has not made profits, okay, or has not made profits as expected. All right, they expected, let's say, $100 million profit, but they made only about $60 million because of the economic uncertainty, and as they like to call it, the VUCA world. The unpaid dividends, the company decides not to declare dividends in a particular year. Then the unpaid dividends plus the current dividends can be paid in any particular year. So that's the meaning of cumulative preference shares. Cumulative preference shares therefore have cumulative aspect with reference to dividend payment. These are called as CPS, cumulative preference share. We also have RPS, redeemable preference share. Redeemable preference shares are those which can be redeemed. Do remember over here, common stock is never redeemed, right? That's the meaning of ownership. Correct. The first point that we distinguish between equity and debt is that equity is never redeemed, whereas debt has to be redeemed, it has to be paid back. Redemption means the issuer has to buy back the instrument. Okay, which never happens in the case of common stock except if the company announces a buyback. So the company announces a buyback and the company then decides to buy back the stock. The common stock, therefore, is never ever redeemed, but preference shares will be redeemed. So you understand that when you talk of fixed rate of dividend, you talk of redemption of shares, then you understand the meaning that this looks like bonds or debentures, but they're not exactly bonds or debentures. Okay? Redeemable preference shares are redeemed by the issuer. Okay? A preference share will typically be 8% preference share redeemable after 7 years. Okay, that means the company will pay 8% fixed rate of dividends. All right, and on maturity or on redemption date, the preference shares are then bought back by the company. So they have some characteristics like bonds, except that they're not bonds, contractual payment involved. Convertible preference shares, CPS. So I just mentioned over here that sometimes it could be cumulative preference shares, and I said that is also called as CPS. So please open your eyes and see what does the C refer to, whether it's convertible or whether it's cumulative. In my mind, most of the time it will be convertible only because that's how the US markets denotes the equity, the preference shares. I'm sorry. Convertible preference shares are converted into equity. Now that's strange, right? So just like bonds, which are convertible bonds or redeemable bonds, on redemption date, the preference shares can be converted into equity, common stock. Okay, they in what ratio? Obviously, the next question that will arise is what is the ratio? This is the predetermined swap ratio, where we take into consideration the prices of both the common stock as well as the convertible preference shares, and then accordingly we decide the swap ratio. So this is pretty simple to understand. You convert it on redemption. A third kind of instrument that is popular amongst Indian companies is called as American Depository Receipts. Okay. Now ADR is issued by companies like ICICI Bank, Infosys, etc., which are listed and traded in the excuse me, New York Stock Exchange. That's the NYSE. A custodian bank is involved. So an Indian company like Infosys has got Indian shares listed on NSE denominated in INR. There's a custodian bank involved which holds a large portion of these shares, and against this holding, the custodian bank issues ADRs, which are denominated in which currency? In USD. And where are they traded? They're traded on the New York Stock Exchange. So that's pretty. It's not really. It's more like a marketing and more of an acceptability kind of a technique, not so much like a capital raising technique as such. So we have about 4 or 5 Indian companies that have issued ADRs and are listed on the New York Stock Exchange. The dividend entitlements, the stock splits, everything that is applicable to common stock, the same rate, the same ratio is applicable to the ADRs as well. Okay. Remember, it will be different in the case of preference shares, but you have corporate actions like stock splits, or you have corporate actions like rights entitlement (REs). Then it will be different for common stock and preference shares because those will be applicable only to common stock. But over here, the custodian bank is holding the underlying stock. Therefore, the dividend entitlements are identical to that of the common stock. There's no preference except that the currency is different. In the case of stocks listed and traded in India, it is in INR. In case of ADRs listed and traded on NYSE, it will be the currency of that country, which is US dollar. Equity could also be of two types, private equity and listed equity. Now, this is big games, okay, over here. Now, we are all watching Shark Tank, okay? We've been fed on Shark Tank US for the last 9 years, and we are watching Shark Tank India regularly nowadays, and seeing that these investors are putting in sums of money into startups, okay? That is called as private equity. So private equity is unlisted holdings, unlisted equity, which is a large holding by few investors. And these are not listed on the SE, that is a stock exchange. SE stands for Securities Exchange. Okay, so the holdings of private equity are typically held only by a few investors. So, who are these investors who hold unlisted equity? These could be the promoters themselves who have started the company. Yeah, the founders who have got together and decided the valuation and the multiplier effect, etc., etc. They are themselves the ones who have started the company. So they will also be holding the unlisted equity in their own company. Okay, it could be private equity investors. Many of us are working in fund accounting. Yeah, we are also investing. We are also looking at doing fund accounting and fund administration for many of the largest private equity companies in the world. Hedge funds, qualified institutional buyers are all examples of uh, unlisted equity. Okay, investors in the unlisted segment. Now, what happens in listed equity? Listed equity is a centralized trading on the stock exchange. Okay, these are recognized stock exchanges like New York Stock Exchange, NASDAQ in the US markets, Tokyo Stock Exchange in the Asian markets, NSE BSE in India, LSE and Deutsche Börse in the European markets. These are all centralized trading. If you go to the previous video, you'll understand that you have to do this centralized trading only through brokers. Traders buy and sell with each other through the brokers. The price performance of the listed equity has got little or no meaning to the impact on the portfolio of the issuer. Private equity, therefore, let's look at the transformation that takes place. Private equity company does an IPO, that's an initial public offering, also called the primary market offering, and the IPO results into the listing of the stock on the stock exchange. So this is the transition that happens from private to listed. Okay, companies can be private forever. Yeah, there's so many companies that we know which have been private for like last 3 decades, multi-billion-dollar companies. There can be companies that have been private for the first 4 5 years, then they've done an IPO, then they've got listed. Yeah, most of the companies like Apple, Microsoft follow this route. Then there are companies like Dell, which have done a listing and they have bought back the shares as well. So you have all sorts of flavors in the American markets, like you have in the Indian markets as well. Listed equity involves trading on the centralized stock exchange. This, once the company does an IPO, there is a listing on the stock exchange. The company is issued what is called as a stock ticker. Okay, the ticker is an alphabetical short form for traders to talk or communicate with respect to each other. And they are also assigned security identifiers called as ISIN or QSIPs, which help the settlement processes take place. The ISINs are associated with equity instruments, and the ISIN, International Securities Identification Number, is issued by the numbering agency in different countries. Listed equity is where all the excitement takes place with respect to settlements and the entire trade life cycle process. We're going to build up the video series to ensure that we then have a comprehensive understanding of how settlements also takes place. So this is a little background about equities. So are equity markets regulated or not regulated? Of course they're regulated. The stock exchange is the first level of regulation, because if you have to list on a stock exchange, then you have to have meet the requirements of compliance as well as regulations, the disclosures, etc. given by the stock exchange. You've got to pay them a hefty fee as well to stay listed. Some of the examples of regulators include SEC in the US, FCA in UK, and MiFID directives in the European Union. Let's do a quick knowledge check to see how much we have understood of uh, equity module. I'm sure all of you have understood it very well. Let's see that. Okay, Hurry Hedge Fund privately holds stock of KH Inc. This is an example of listed equity, right? I'm sure it is. Because it's privately held, it is listed, correct? Go back to the example on Shark Tank. If you want to give your answer, post your answers in the comment section below. Infosys Limited ADR is about $12.11. So, what is the currency of the ADR? Is it INR? Is it USD? The question is, what is the currency of the ADR? Okay. The third question is, preference shareholders will get dividends before interest payments to bondholders. That's what they're called as preference shareholders. Give your answer to this, because I need to know whether you've understood this video on what are preference shares. So is this true or is this false? Like at the time of payments, interest payment is paid, the preference shareholders will get dividends before the interest payment is made or after the interest payment is made. Let me know your answers in the comment section below. And as usual, the next lesson, do you want to know what it is? It will be on understanding fixed income securities. I'll try to increase the speed of my posting of videos so that we get a comprehensive lesson plan in place quite quickly. Okay? So thank you so much. Post in your answers in the comment section below because I'm waiting to hear from you. Thank you.